When the price of gold doubles, the value of the dollar is cut in half, measured in gold. The dollar already collapsed, but everyone's looking in the wrong place. They're looking at the euro, the Aussie dollar, the Canadian dollar, the Japanese yen, the Swiss franc, whatever. These are all passengers in a lifeboat, okay? But they don't, you're all in the same lifeboat. Some are taller, some are shorter, some are smarter, some not so much, but they're all going to sink or swim together. There's one and only one form of money which is not in the lifeboat, which is an objective measure, a yardstick, independent of central bank policy. So what can investors do? I said earlier that monetary policy doesn't work because of velocity, and that fiscal policy doesn't work because the debt to GDP ratio is too high. And I said there was one thing that does work, but I didn't tell you what it was, but I will now. Deflation is the problem. We have disinflation now. We're going into deflation. Deflation is the problem. You have to break the back of deflation. You have to cause inflation. I know inflation is a naughty word among gold investors, but actually that's the best way to get the price of gold to go up a lot. It's going up anyway. How do you get inflation, especially when you need it, when you're suffering from deflation, which is bad in its own way? You have to change the psychology. And it's been done twice. It was done in 1933 by President Roosevelt, and it was done in 1971 by President Nixon. And both times they devalued the dollar against gold, which means you increase the dollar price of gold. Everyone's like, oh, gold's going up, gold's going up. And I say, no. Yeah, it is in dollar terms, that it is. But what you're missing is that the dollar is going down. People come to me and say, Jim, you've been predicting for years the dollar is going to collapse. When's it going to happen? I said, it already did happen. What do you think happened between December 16, 2015 and August 2020, when the price of gold doubled from $1,000 an ounce to $2,000 an ounce? In round numbers, it was 1051 to 2019, right? But call it 1,000 to 2,000. When the price of gold doubles, the value of the dollar is cut in half, measured in gold. The dollar already collapsed, but everyone's looking in the wrong place. They're looking at the euro, the Aussie dollar, the Canadian dollar, the Japanese yen, the Swiss franc, whatever. These are all passengers in a lifeboat, okay? But they don't, you're all in the same lifeboat. Some are taller, some are shorter, some are smarter, some not so much, but they're all going to sink or swim together. There's one and only one form of money which is not in the lifeboat, which is an objective measure, a yardstick, independent of central bank policy, and that's gold. The only way you can understand what's going on in currencies is compare it to gold. And so when the dollar price of gold goes up, I just say, well, that means gold doesn't change. It's atomic number 79. It's an element. It's the same thing. If the dollar price of gold is going up, that means the dollar is getting weaker. If the dollar price is going down, that means the dollar is getting stronger. So if you want to forecast gold prices, you have to ask yourself, is the dollar getting stronger or weaker? And then that's a pretty good basis for making a forecast. But the difference between gold and all the other currencies is gold, of course, is the only one not printed by a central bank, not subject to manipulation as a supply. There is new supply, but new supply has been static at about 300 metric tons per year for the last 5 years. So that's not expanding dramatically. And that's a very small, it's about a 1.6% increase on the global above ground supply. So that's not a big number either. But gold is your thermometer to tell if the patient's sick or not, the patient being the dollar. And you've got to devalue the dollar against gold, which means increasing the dollar price of gold, to break the psychology. And the reason you're doing this, of course, gold investors would love it, but that's not why a central bank would do it. They would do it to change the psychology and increase the price of everything else. Franklin Roosevelt did it in 1933. He increased the price of gold from $20 an ounce to $35 an ounce. And he didn't do it to reward gold holders. In fact, he confiscated all the gold first. So it was the ultimate insider trade. But what happened when the price of gold went up, guess what else happened? Oil, wheat, corn, steel, land, everything else went up, and people could pay their debts and the economy got going. And we had a boom in the middle of the Great Depression. People don't understand the Fed. They don't understand monetary policy. And by the way, the elites like it that way just fine. The average American probably thinks Federal Reserve is a brand of aged whiskey or something. So look, you understand it. I understand it. The Board of Governors understand it. Actually, they don't. They're not very good at what they do. But there's some experts and analysts and some members of Congress who do, but that's about it. This is not, the creation of money is one of the great mysteries. It's actually not that big a mystery, except it is because people don't know how it works. For those who do understand it, they have increased the money supply radically, but it really doesn't matter very much at this point because there's no velocity, there's no turnover of money. The Austrian economists, the neo-Keynesians, the monetarists, they all agree on one thing: that's if you create money, you're going to get inflation. An increase in money supply will be an increase in prices, etc. That's not true. It's empirically not true. Just go back to 2008. In 2008, the Federal Reserve balance sheet was $800 billion. Today, it's about $7.5 trillion. Even as late as 2015, it was $4.5 trillion. Where's the inflation? We don't have it. So that means that money supply does not correlate to inflation. The key to inflation is a serious problem, or will be, but the key to inflation is not money supply, it's velocity. It's the turnover of money. And the problem right now, are they creating money? Yeah, they're creating it like crazy.
Right.
But all they do is they give it to the banks to buy treasury notes. That's how they increase the money supply. They stick the treasury notes on the Fed balance sheet and they just sit there. The banks have the money. What do they do with the money? They give it back to the Fed in the form of excess reserves, and they get a little bit of interest on it. But the money doesn't go anywhere. It's the lending, the spending, the increase in basically the turnover of money that could give you inflation, but we don't have that. Why? Because people are scared. They're, if you lost your job or your business shut down, you're not spending. You're either paying down debt, paying bills. But when you pay bills, that's not spending. That's just reducing your balance sheet. Spending is like going out and buying dinner or Christmas presents or a new car or something. People are not doing that with very few exceptions. So, and the banks aren't really willing lenders at this stage, except to certain sectors. So you're not getting lending and spending, you're not getting the turnover, and therefore you're not getting the inflation. The money is just piling up and it's not going anywhere. If you get the laws of economics right, which is not easy because most economists don't, but if you get them right, it's really a reflection of human nature. I mean, what is an economy other than all the people in the economy starting businesses, buying, selling, traveling, providing goods and services, etc. So human nature doesn't change, or at least it hasn't changed much in the last 100,000 years. So the fundamental laws of economics don't change either, but circumstances change, facts change. I'm giving you the solution. I say the same thing to people in Washington. They don't listen, but I'm happy to share. I'm giving you the answer, which is you've got to increase the dollar price of gold to get the inflation and everything else to get out of the deflationary rut.